You are listening to ChartingWealth.com's weekly review and forecast for the week beginning Monday, the 7th of December, 2015. Let's jump right in. This is the one time each week that we actually look at what's going on the weekly chart and see how the last week wrapped up. Now, when we look at IYY, what is that? Well, that is the Total Market Index Fund. So it shows us what's going on in the total market. What do we see happening? Well, we saw a crossover occur back on the week ending, October the 23rd, 2015. The market actually crossed over on the weekly chart, going up, and it's gone up for 3 weeks after that. Actually started going up back on the week ending somewhere around the 9th, but didn't cross over until the 16th. The 23rd rather, and we've seen the market go up and then slide sideways over the last several weeks. This past week ended up with an open red down candle, which again is better than a closed red down candle with a long wick on the bottom, but again just it continues to show just some sideways slippage as we've seen since the market ended its up moves. And if we start looking at actually what's going on here, we can see that on the week ending the 6th of November, it has not closed higher since then. And that week ended that we're talking about is the 12/4/15. So in other words, we have not gone higher. In fact, we've not gone higher than the highest high at all, but we've not even closed higher since November 6. So what's that telling us? Well, we're in a confirmed up move still on the moving average convergence divergence, which is our main indicator that we like to use. You want to know more about that, you can find more about it at our website. You can also just look it up on Investopedia to understand what it actually is. Now, the complicated math behind it, I'm not going to begin to try to explain to you, but I will tell you that it is an indicator we like, and it continues for me to be the most accurate indicator that I can find to help give me the most accurate roadmap of where the market has been and where it is going. The derivative oscillator is losing steam as the market continues to slide sideways, and we don't have a coming together. We have a divergence still between the MACD and the signal line. So the week ended up as a red open candle on our Hinky Iashi, that's Heikken -ASHI. That's a type of candlestick that we like to use, that we find most accurate. And what we see happening is, again, the market has just been sliding sideways for 4th going on 5th week now. We'll see if it continues to slide sideways or if it will break out toward the end of the year. Now, if we look back at what happened throughout the course of the week on our daily chart, what we see is on the 30th, the market had actually what we call a doji, which is where the market shows a great deal of indecision. And then we had an up move on Tuesday the 1st, and then we had down move with a lot of indecision on Wednesday, major down move on Thursday, and then Friday it backtracked a little bit. So huge down move on Thursday. That was related, as we have been told, to the European Central Bank not giving out the amount of stimulus that the market wanted. In other words, more free money, more goodies. Not talking about how well the markets were doing or anything else but simply monetary policy. It's a shame that that is what appears to totally drive all of our stock markets these days. But again, we trade based upon what the charts are doing. We trade based upon what we're seeing. Whatever the stimulus, the motivator might be, we're looking to capture the up moves and the down moves and pay close attention to what's really going on. So market is still a confirmed up move, bit of a down move there toward the end of the week in an attempt to recapture that up movement. So now let's go back to our weekly chart. We're going to look quickly at SPY, which is going to look somewhat similar on that weekly chart. We see a crossover on the 16th moving up. A lot of up movement we saw until around the 6th of November. And when I said 16th, I'm sorry, I meant the 16th of October. We saw a crossover there that following week on the 23rd. like we saw in the IYY, the total market, and then we saw on the 6th of November where the market reached its highest highs of the year so far and then started sliding sideways. And that is where we are right now with a red open, sort of a spinning top. Again, some indecision right now. The derivative oscillator is losing some speed. The MACD and the signal line are continuing to diverge, that is moving apart. And if we go to our one-day chart, our daily chart, we will see that starting on Monday the 30th, it looks very similar to what we saw on IYY. And again, the reason that IYY, the total market, and the S&P 500 will look similar quite often is because the big market's everything. S&P 500 is not everything, but it's the 500 big companies, which are a lot of the volume of the market. So we see some indecision as the week started, an up move on Tuesday, and then more indecision on Wednesday, and then that plunge down based upon the ECB, the European Central Bank's news, and then an attempt to recover some on Friday. So down move confirmed on the daily chart, but we're still in an uptrend on the weekly chart and will be until and unless that changes. Now, the Qs, which is the NASDAQ 100, is different than these prior two charts. It's technology, and it is a smaller index. It crossed over going up on the weekly chart, back on the week again, somewhat similar, the week on of the 23rd of November, but it ticked up until the 23rd of October. It ticked up until the 6th of November. And of course, like we saw in those other charts, it started sliding sideways, but it actually over the last 2 weeks has ended up with green up candles. And in fact, we've seen a greater divergence on that MACD on the big weekly Qs chart. So it's continuing to track up. Now, as far as tracking up and closing higher, it's actually hit the highs. And as of this week, it closed actually, it appears, right at or maybe just a little higher than it had been on November the 6th. So we're seeing better performance, at least as these charts go, and reaching higher highs on the NASDAQ 100, these technology stocks, than we are on the total market in the S&P 500. Now, if we jump back to the daily chart and look at what's going on there, we can see again same effect on Thursday by the ECB's news, but a lot bigger down move than the market ended up on that chart on Thursday. In fact, there was a big down move, but then it recovered, is what I'm saying, recovered substantially. And then an up move on Friday. And again, the week had started with up moves Monday, Tuesday, and Wednesday, that sharp down move on Thursday, and then a bit of a recovery on Friday. It's still in a confirmed down move on the short chart, but in a confirmed up move on the weekly chart. Now, lastly, that is where our indexes are. So all of our indexes confirmed up moves on the big chart, down moves on the dailies. Now, let's look at gold. What is gold doing? Well, we see gold on the weekly chart crossed over going down on the week, ending the 13th. And again, that's a confirmed crossover. It actually started going down back on the 30th. Confirmed down move after it crossed over going down. And I'm not giving you the months, I'm sorry. The 30th of October, confirmed down move crossing over on the 13th of November. And it has continued to move down, still in a confirmed weekly down move. Derivative oscillators also in the red. But what did we see happen over the course of this last week? Well, it's primarily as to what happened on Friday. If we go and look on the daily chart, you can see Friday the market moved up substantially in gold, crossed over the 2-day trend line that had been going down, 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 and bam, moved up with significant I would say vigor. It started in the morning with a bit of an up move on, actually not in the morning, but started on Thursday with a bit of an up move, and then just pounded itself up on Friday. Significant move up. It had already crossed over on the daily chart, but it had been sort of going back and forth, but it crossed over sometime around the 30th of November, and then plunged back down on the 2nd, but then shot back up on Friday, pushing through the 2-day trend line And hopefully gold has hit its bottom at somewhere around 105.50 and is now confirmed moving up substantially, and hopefully we'll see it continue to do that. Now, lastly, let's jump into what we saw in the news this last week and where we might be going this next week. A lot of interesting things going on. U.S. payrolls grew by 211,000 for what was reported in November. Now, when we start looking at U.S. factory activity, though, it falls to a 6-year low. The Institute of Supply Management gauge of U.S. manufacturing fell to 48.6 in November. That is somewhat concerning. Service sector growth is stalling. The ISM index of non-manufacturing activity fell in November. We start looking at auto sales, however. They are on an incredible pace. They continue. It looks like U.S. auto sales topped 18 million annually for a record third straight month in November. Well, when you have free money from the banks and anybody can go buy a car and finance it with either a lease or a long-term loan bordering on how long it might take you to pay off a house, yes, you can continue to sell cars until the Federal Reserve starts kicking up the interest rates, the dollar loses its value. U.S. productivity rises. U.S. non-farm productivity increased 2.2% in the third quarter. Our trade gap has grown 3.4% as exports fell and imports declined. Let's see, U.S. jobless claims increased to 269,000. They rose 9,000 more people. This is the big one that we talked about earlier. The ECB, the European Central Bank, lowered its deposit rate to minus 0.3% from minus 0.2%. So they're charging banks more for depositing cash with the central bank. The president said they would extend quantitative easing program through at least 6 months until March 2017. But the ECB fell short of market expectations by holding QE steady at its current 60 billion euros in their monthly buying rather than increasing the amount. So that is what the drag on the market was, is that they weren't increasing quantitative easing. Now remember, what's quantitative easing? That's nothing but printing money backed by nothing. That's the problem with fiat currency. China's manufacturing contracts in the month of November. Now this is another interesting one. The yuan, that is the Chinese currency, the International Monetary Fund has now decided it will include the renminbi, or the yuan, as an international reserve currency beginning in October 2016. So in other words, that Chinese currency backed by a communist government is going to become one of the milestone currencies along with the British pound, the euro, and the US dollar, and the Japanese yen. Fascinating, isn't it? India's GDP has risen 7.4%. And the S&P, now this is an interesting one, has cut its bank ratings. The credit rating agency S&P, Standard & Poor, has lowered its ratings of 8 big U.S. banks. Why? Well, it says that the government was less likely to provide necessary bailouts. Those banks include J.P. Morgan, Wells Fargo, Bank of New York Mellon, State Street, Goldman Sachs, Morgan Stanley, Citigroup, and Bank of America. Interesting. Well, that was the news from the week. Let's talk about what's happening that might affect your marketing calendar for this next week. Well, we have on Monday, Japan's going to report its GDP, its gross domestic product. That's going to come out on Monday the 7th. The Tuesday, we're going to see a couple of things occur. China's going to report its consumer and producer prices, and there's going to be the U.S. job opening and labor turnover survey is going to be released. Then we're going to see on Friday a couple of things occur. U.S. retail sales, business inventories, and consumer sentiment are going to be reported, and China's going to release its industrial production data on Friday. Nothing big from the Fed or anything like that as the holidays approach, but again, continue to pay attention. Maybe we'll see something on Friday depending on what China reports and how U.S. retail sales, business inventories, and consumer sentiment stack up. But nothing huge and potentially crushing in the market. It does not sound like at the beginning of the week. We hope that all of this is helpful to you. This is the one time, once a week, that we actually sit down and review what's going on in the total market, the S&P 500 and the Qs on a weekly basis along with gold. So hopefully that's helpful, talking about what moved the market this last week and what might move it as we go into this next week. And again, remember, the charts are your roadmap to what the market has done and where it may be going. And we encourage you to listen, study, go to the website, listen to the trainings that we've put on there, practice, open yourself up a virtual trading account at any of the online brokers, and then start learning to trade. We're not a stock calling service. We encourage you to pay close attention to what we talk about and then experiment, do virtual trades on your own. And when you get good enough and you get successful enough at doing these things, start making your own money by making your own decisions. This is all about empowering you, not telling you what to do. Thanks so much for listening to us. Please join us every day for our daily review. To get our daily review every day, along with our How to Read a Stock Chart video, the layout that we use at freestockcharts.com, our own layout that we've designed, and to get our weekly review and forecast, all of those are free. You just have to go to our website, chartingwealth.com, and sign up, and we'll get them to you. Thank you so much. We wish you the best, and the best in seasons. Greetings from chartingwealth.com.